Now, let's try to look at some of the important aspects of personal taxation. So, personal is something that is more and more applicable to the individuals. So, what are the things that the individuals are typically taxed on? So, on a broader note, the first major thing which an individual would be levied a tax on is the income of the individual. And when we talk about the income, we are talking about two major forms. One is the earned income, which contain the salaries or wages of the people, and another one is the unearned income. It's not because of the work, it will come even if you don't work, like the rent on the property or the income on the investment that you have done. These go as a part of the unearned income. All this goes as a part of the income, and a tax needs to be paid on the top of that income. Or it could even constitute a profit, especially if the person is a proprietor. So in proprietorship concern, whatever the profit that came to the company, to that particular firm, is also taxed as an taxed for the proprietor as an income tax only. Even if he is a part of even if he is a partner, corresponding to the share of his profits in that particular firm, the taxation would be applicable. And any kind of wealth that is inherited from the ancestors, even that particular is taxed. Any kind of capital gains which are like I have bought or sold some kind of assets, some properties, or some kind of building, some kind of shares, bonds, any kind of buying and selling that has resulted, there is an investment gain in it, there is a tax that is done. Now, in all these things, one thing that is common is the taxation at an individual level. This entire thing contributes to the tax. But before just adding up all these things, a few important things that needs to be considered is the taxation happens purely on the cash flows. What does that mean? It is only when we have really received the cash, only then we are paying the tax on it. Probably when I am saying I have purchased the share at 100 bucks and today it is 120 bucks a share, and let's say I have purchased 10 such shares. So if you see, my profit is 20 bucks per share and overall I have 10 such shares, so my overall profit is 200. But so there is a capital gain, but I'm not paying capital gain tax on this 200 because I haven't actually realized it. I did not get the cash out of it because I did not sell the share. I'm still holding on to it. So that is what the meaning of the taxation happens only on the cash flows. Only if I have really received the cash for that transaction, only then I am paying the tax. So which means actually it's not a virtual stuff or it's not a bookish entry. The finance really need to be available on that transaction to really pay the tax. So in almost all the cases, it goes with the concept of realization. Only when I have realized that particular profit, only when I have realized that particular amount, only then I am paying the taxes on the top of it. That's one important taxation principle. And the taxation generally happens in arrears only. Along with the ability to pay, we are also talking about matching. I mean, the funds should be available to pay. So generally, whatever are the salaries or whatever was the income right from, let's say, 1st April 2014 to 31st March 2015, the tax need to be paid, let's say, by 30th June 2015. So the kind of income or the profits of the previous year, we are paying the tax in the current year. So that is what we are saying. Generally, the taxation happens in arrears. Make sure that we have already received the cash, and only after we have received it, we are making the payment. And in general, there could be at some companies level, there could be a tax deducted at source, especially for the employers. They do this for their employees and try to accelerate the tax payment process. But finally, it is that final assessment that is done at the end of the period which will finally decide whether the person has to pay even more, some more balance, or he is going to get some credit because he has paid more than required. But that is purely a kind of an arrangement to accelerate the tax payment process. But otherwise, it is purely done in arrears only. That's one more important aspect of the personal taxation process. Then what we also see is the taxation happens only once. Whatever is the revenue flow that comes in the hand of a recipient, it is taxed only once. So these three things typically go as essential elements of any form of taxation. And added to this, if I have to really compute how much is my taxable income, right? If I have to compute how much is my taxable income, first of all, check if there are any items of your revenue, any element of your revenues which are tax free. If there are any such elements, you will not show them as a part of the revenues for the computation of the taxable income. Probably in some countries we see some gambling profits. They are to a large extent exempted from the taxable income computation. And any kind of social security benefits that are received, there is no tax that is levied on them. So we have to check in that particular country, are there any such kind of taxable, tax-free kind of revenues that are there. Similarly, I should also see, are there any kind of tax-free expenditures also. Whatever we are spending, in some cases, it might be completely tax-free. Probably any kind of donations that I give, I'll be completely exempted from tax for that. Any kind of charitable contributions that I am doing, or any kind of insurance premium payments, life insurance premium payments, all these, they are completely exempted from tax. So a good understanding of what revenues are tax free, what expenses are tax free, really need to be understood. Along with that, probably some kind of fringe benefits where the employer can give some kind of a benefit to employee. He might give a car to the employee, which could be as a part of the salary, but even that would be included as a part of the taxable income. So it may be payable in kind, it is not a cash driven stuff, but still it would be treated as a revenue and a tax need to be paid on it. And regarding the investment, any kind of dividend or interest, that investment income, it typically has a tax deducted at source kind of a mechanism. But yes, if it has already been deducted, it is typically offset against the personal liability, whatever is the overall tax that needs to be paid. This whatever TDS that is deducted, that would be adjusted according to that. And on the top of all these things, there is something called as an allowable income or allowance for each individual. Probably for males, it could be something, for females, it could be something. Means the minimum level of income below which the tax is not applicable. So it is completely talking about what is that tax free level of income. Only above that, the tax would be charged. So that much of income, that much of capital, which is reflecting the individual, which is reflecting the gender, some such kind of basis would be used to compute that kind of an allowance. Now, that much of up to that much of income, the tax would not be levied, which means that part is deducted from the income, and only on the difference the tax is typically paid. In some cases, age allowance exists, senior citizens versus regular. In some cases, the allowance comes for married couples. But whatever is the scenario, the different allowances we can understand, that is the maximum cap up to which the tax is not levied, and only on the top of that, in case your taxable income goes only above that, that is when the tax payment really has to happen. And whatever is the marginal tax rate, whatever is the slab corresponding to that particular taxable income, it would be directly applied on that taxable income to compute the total tax liability of the individual for that particular period, right? So that's a typical computation mechanism that is followed for computing the taxable income. Now, for example, let's say we have an allowance. We are having let's say we are having an allowance up to 100,000 bucks, right? There is an allowance, let's say up to 100,000 bucks, and probably the tax rate is 30%, right? Or probably I'll say the tax rate is 20% for the tax rate is for the initial 100,000 there is no tax, and it is 20%, let's say, for an income up to 500,000, and let's say I am charging at the rate of 30% for any income that is above that. Now let's say we are talking about an individual whose whose income is around 1 million. Now, because his income is 1 million, first I'll see the allowance. The allowance is 100,000, which means he has to pay a tax on the remaining 900,000. Right? He has to pay a tax on the remaining 900,000. But up to the first 500,000, he is taxed at the rate of 20%. So 20% on the first 500,000, he is supposed to pay on that 20. So 100,000 is here up to 500,000. This is the means 100,000 and 1 to 500,000. Let's say this is the tax rate. Means on that 400,000, he has to pay at the rate of 20%. So which will give 80,000 as the typical tax to be paid. and on the remaining 500,000, which is the salary above that cutoff rate, he has to pay at the rate of 30%, means 150,000. Overall, his tax liability is 230,000. So that's how that we typically compute the tax liability that is supposed to be paid, right?